Did you pay thousands of dollars in taxes last year, only to realize that no one ever told you just simply changing your business structure could save you a big chunk of that? If you're a sole proprietor or an LLC and you feel like you're paying way too much in taxes, this video could literally put money back in your pocket. Today, we're going to talk about how your business entity, or lack of one, may be draining your bank account. Hey everyone, I'm Jamie Trull, CPA and financial educator, and here on this channel, I love to bring you all the information you need to stay informed, organized, and profitable in your business finances. And today I want to talk to you about one of my favorite tax strategies that also happens to be one of the most misunderstood. Stick around to the end because I'm going to give you the resources that you need to figure out what the best next move is for you. Okay, so let's talk about business entities. Most small business owners by default are going to end up being sole proprietors when they first start out. And that's because that is the default classification for pretty much anybody who is making money in their own business or is a freelancer or a 1099 contractor. You are going to be assumed to be a sole proprietor for legal and tax reasons. Now, the reason that I'm not against sole proprietorships is because that actually can be a decent structure. It costs the least, it has the least amount of rules and regulations that you need to follow, and you get to simply just be able to file your taxes with your regular tax return. But for most businesses, there comes a point where it does make sense to go to the next level. So typically the first step for many business owners is to create an LLC. And an LLC is a limited liability company. Now, one of the things that is most misunderstood is that an LLC in and of itself will save you on taxes. That is not true. From the eyes of the IRS, an LLC is taxed exactly the same as a sole proprietor, which may make you wonder why get an LLC at all. And really the benefit of an LLC is going to be the legal protection. Now, I'm not a lawyer, so I can't speak to all of it, but I do know that having an LLC will help protect your personal assets in case your business is ever sued and found liable. So both sole proprietors and LLCs, if you have not made any further elections, are going to be taxed exactly the same. And they're going to have multiple different taxes assessed on them. Those entities are going to have federal income tax assessed, state income tax, or any other state taxes that might be applicable. And you're going to have self-employment tax on the full net profit of your business. And when I talk about net profit, that means the profit left in your business after you have deducted those deductible business expenses. So basically, sole proprietors and LLCs are paying all the taxes. So if sole proprietors and LLCs are generally taxed the same, how do we actually reduce the amount of taxes that we pay based on our entity type? Well, that is where the S Corp election comes in. Now, interestingly, both existing LLCs and C corporations can elect to be taxed as an S corporation. That means that legally you're still the entity that you set up. However, from the IRS's perspective, how you are taxed changes. And what I see most commonly for small business owners is to start as an LLC and then to eventually elect S Corp tax treatment when it's determined to be beneficial for you. So how exactly does an S Corp potentially save you money? Well, the biggest change is that now you actually get to separate the money that you make into two different buckets. Instead of just one bucket that has all the taxes assessed on it, your profit gets to be split into two separate segments. The first, and the one the IRS cares about the most, is your reasonable salary. This is an actual salary you give yourself that should be commensurate with the work you're doing in your business. So what would you pay somebody else to come in and do the work you're doing in your business? And that portion has all the same taxes as usual assessed on it. That means federal income taxes, state taxes, and self-employment taxes. But here's where it gets good. The second bucket, any profit that you make in your business above and beyond what is deemed to be your reasonable salary, becomes additional money that is taxed differently. Now, you're still going to have federal taxes on it. You may still have state taxes on it as well. However, you aren't going to have self-employment taxes on that second bucket. And just an FYI, self-employment taxes are the same thing as payroll taxes. They're just called something different when you're self-employed. And for someone who's self-employed, those taxes are typically 15.3%. So the more money that you put into that second bucket, the more you save. Now, real quick, I'm going to put some actual numbers and an example up on screen so you can see how this actually can work in the real world and how it can save money. So let's walk through a back of the envelope example here, and you can see what I'm talking about. So here we go. Let's say you make $100,000 in profit in your business before paying yourself. So this is, again, profit after those deductible business expenses. And let's say that you determine your reasonable salary for the work you do in your business is $60,000. Now, I'm not going to get into all the ins and outs of coming up with your reasonable compensation, but I have lots of other resources on that on my channel, so make sure that you subscribe and go check them out. All right, so in this scenario, we've got that salary of $60,000, which is going to be the compensation for being an active employee in your business. That's going to be taxed when you pay yourself. You're going to have withholding taxes, just like you would for any other employee that you were employing in your business. And you're going to pay that self-employment tax and income taxes. And that income tax, of course, is going to vary depending on your full tax situation. Now let's come over and talk about this remaining net profit. This is the money you made above and beyond your reasonable salary. This is that bucket too that we want to be able to maximize because that's where you're going to be able to see the most tax savings. Now, this money is what's available for owner's draws. And that's really money that you're essentially paying yourself for being more of an owner in your business. That is why it doesn't actually have self-employment taxes taken out of it, because it's seen really more as investment income, and therefore you only have to pay regular income taxes. So let's do a quick calculation. And again, this is a back of the envelope. It actually can get much more complicated than this, but this can actually be illustrative to help you decide if it's time to start looking at becoming an S Corp. So in this specific instance, when you're an LLC that is taxed as a sole proprietor, which is the default, you can see that the money that is subject to income tax and self-employment tax is both the full $100,000. And let's say your tax rate is 25%. We're going to put that 15.3% self-employment tax. Again, that's also called payroll taxes. That's your Social Security and Medicare. Your total tax in that situation comes out to $40,300. But let's say we're in the situation where we're actually being taxed as an S Corp instead. Well, now you'll see that the full $100,000 is still going to be subject to income tax, but it's only going to be that owner salary, that reasonable compensation of $60,000 that is subject to self-employment taxes. So that's where you're going to see the savings when it comes to an S corporation. And this is why for people who maybe aren't making profit of at least $70,000 or more, it may not make sense to be an S corporation because you may not have enough money to put in that second bucket that doesn't have self-employment tax taken out to make it worthwhile. But in this situation, this back of the envelope comes out to a savings of about $6,120. Now, I want to do one more example just to show you how this can really vary. So let's say you are a higher profit earner. Your business actually makes $175,000. And when you go through the process of setting your reasonable compensation, you determine that you can justify a salary of just $50,000. Well, in that case, you can see what those tax savings would be. This is where you would have some pretty significant tax savings to be considering. And this is exactly why I recommend people start to look at whether an S Corp election could be right for them, because there is some significant savings abilities here. So hopefully that helps illustrate that for the right business at the right time, an S Corp election really could save you significant money in taxes. However, not everyone is ready for S Corp, and that's okay. There's actually a sweet spot where it really makes sense for you. And before that, it could actually be more of a burden and cost you money. And I'm going to tell you right now, this is a common issue that I see where people end up switching too early. They aren't educated by their financial professional about what the switch actually means. And then they end up having to deal with all types of headaches just because they made the switch and listened to that professional. And the reason this is frustrating is because if you do switch too early before you're sufficiently profitable for this to make sense for you, you're going to have to deal with the additional cost and compliance that comes with an S corporation, a lot of which actually ends up in the pocket of that accountant that recommended it to you. Unfortunately, S Corp isn't one of those things that you can just elect one year and not elect the next year. So that means if you make the election, you want to make sure that you plan to be consistently profitable enough that it will pay for the additional administrative fees of being an S Corp and still save you money on top of that. So the big question, when does it make sense to switch to an S Corp? Please don't hate me for this answer, but it depends. And the reason it depends is because the calculation, unfortunately, isn't as straightforward as the example I showed you earlier. In reality, there are some complicated tax calculations involved, including things like the qualified business income deduction that can really impact your calculation. And that calculation is going to be super specific to your personal situation. And that's why if you're working with a CPA to determine if this is right for you, you want to make sure they are doing a full analysis, not just a back of the envelope. And you also want to make sure that they are including the cost to become an S Corp in that calculation. All the additional administrative things you'll need to pay for, like an extra tax return, payroll, things like that can add up. But overall, the key to saving with an S Corp is ensuring you have enough profitability in your business to be able to pay yourself a reasonable salary and have additional profit above and beyond that. And that's because the savings of an S Corp only kick in after you've already capped out that reasonable salary and have additional money that you've made. And that's because the real benefit of S Corporation taxes is that the amount above and beyond your reasonable salary has a lower tax rate associated with it. Now, the ultimate key to whether this is going to make sense is whether you can pay yourself a reasonable salary and have additional profit left over to pay yourself additional draws. And that's because the first money that you pay yourself needs to be that reasonable salary, and it's going to have all the taxes assessed on it. So it's really only profit above and beyond that salary that is going to have a benefit by being an S Corp. Now, again, this is going to be highly dependent, but I usually tell people to at least start looking at whether S Corp might be right for you around $70,000 or more in net profit. If you're making less than that, it's fairly unlikely that an S Corp would save you much in taxes, and any amount it did save you may be fully offset or more than offset by the additional administrative costs. And at that point, you're just shifting money from the IRS to your accountant and not back to you. I can't tell you how many business owners I've talked to that are surprised to learn that this actually could be beneficial for them. They hear S Corp and they think that that is something for when they're making millions of dollars, but that is not the case. I actually find that this structure is most beneficial to those making in the low to mid six figures. So if you are already making that kind of profit and you're still operating as a sole proprietor or an LLC without an S Corp election, you might be leaving thousands or even tens of thousands on the table. And even if you're not there yet, but you're planning to hit those numbers soon, you'll want to understand these rules so that you can make the switch at just the right time. This is one of those decisions that has a compounding effect. The sooner you optimize your entity structure, the more you're going to save over time. So if you're watching this and you're wondering what your next steps are, you have options. If you have a CPA that you trust, you can consult with them over whether S Corp is right for you. The key is just to make sure that they're doing a full calculation and analysis. And unfortunately, you're probably going to pay for it. But if you're more of a DIYer or you want to do some more of your own research before approaching your accountant, I have created just the resources that you need. My S Corp toolbox actually gives you all the resources you need to determine if S Corp is right for you and even to make the election yourself should you choose to. It also includes resources to help you understand and stay compliant with the rules of being an S Corp, including some things your accountant may not tell you about. And just for fun and just for our YouTube audience, we've decided to give a special deal that is currently going on. Right now, our YouTube audience can save $100 on our S Corp toolbox at jamietrull.com/S Corp save. Now, that's our specific link just for YouTube. You won't find it anywhere else. So if you decide this is right for you, make sure to use that link. Again, this is a limited time deal, so it will go away, but you can go check the website and see if the deal is still active. Now, if you are already an S Corp or you know that you're going to be electing it this year, the most important thing to figure out is going to be your reasonable compensation. So if you're looking for help in figuring out a reasonable salary that will satisfy the IRS without leaving money on the table, helpful, you'll definitely want to check out my free masterclass, the Savvy S Corp Owner Masterclass, Getting Your Salary Right. You can check that out at jamietrull.com/salary. If you want more tax savings tips like this, make sure to subscribe to the channel, and also make sure to watch this video next, which talks about the hidden costs of an S corporation. As much as I love this tax strategy, I want people to go in eyes wide open, so it's really important that you have all the information you need before you make a decision. I'll see you next time.